Good afternoon, good evening, good morning to everybody here. Thank you all for joining our end of year roundtable. I'm Heidi. I'm your host today. I'm with Management One. I'm with the customer success team. And today I'm with the Zoom success team. Before we get started, we're going to let some more people roll in, of course. But before we get started, I want to let everybody know we are recording today's session. So you will get it in your inbox after this. So no need to take notes. We'll send you the recording, but I do want you to know that stick around the whole time because we have a Q&A session at the end. No need to write down your questions either because we've got a Q&A box at the very bottom. So submit your questions there and our esteemed panelists will get those answered at the end. I will pop back on to read your questions to everybody. So give me just a few more seconds here to let this is what every Zoom host does. We wait for just a few more people to roll in. So thank you again for joining. If you are just now joining, I'm Heidi with Management One. We are going to have a question and answer session at the end. So enter your questions at the bottom little box there that says Q&A. You see that slide right there that shows you where to do that. Without further ado, might as well get rolling. Let me introduce you to our two panelists today. We've got Andrew Bass. He is the Chief Wealth Officer at Telemus Capital, which is part of Covitz, where he is responsible for the tax and integrated wealth planning for their high net worth clients. Andy's been helping business owners structure tax planning and strategy, most recently at one of the largest CPA firms in the world. Today, Andy's going to give you his best tips on what to do if you're a small business and how to save some money at the end of the year, potentially things you don't want to reach out to your accountant about or they have not reached out to you about yet. Marc Weiss is the founder of Management One. He led our company for more than 35 years. Marc has worked with thousands of independent retailers to achieve financial security by delivering best-in-class demand forecasting, inventory planning, and strategic consulting. Marc is a former retailer himself, so he knows just what he's talking about, and he's now one of the foremost thought leaders in the independent retail community. So that is your wealth of knowledge you've got going for you today. I am going to hop off screen, and I will see you at the end of this. Go get them, guys.
Great. Thank you, Heidi.
Thank you very much, Heidi. Really appreciate it. Appreciate the kind words in the introduction. And I'm happy to be here with my friend and colleague, Andy Bass. He's a source of knowledge, wisdom that has been invaluable to me and Management One. So I'm really appreciative of you and Covitz and Telemus being here today. So thank you, Andy.
Thank you.
So the two things that are on the top of everyone's mind is the T words, taxes and tariffs. We're not going to talk about tariffs today, but I will pre-plug a webinar I'm doing at Magic on February 11th with Lloyd Parks, who will be talking about shifting production, when, where, what to, and how to move. And I'll be discussing assortments, pricing, and profit strategies. So it is an important topic, and we'll have more information, obviously, after the inauguration. But taxes are a topic today. And what are the things that you can do between now and the end of the year to save some money? And what should you be thinking about in terms of your taxes for 2025 and on? Because there's a lot of levers that you can pull in your business for the benefit of taxes. And we're going to be talking about those. And then at the end, we'll be happy to answer your questions. So thank you. So Andy, we're in a new era with a new president coming in. Tell us what you're thinking about.
Well, thanks. This is a difficult topic to really get into a lot of depth on at this time. We're in such a period of transition that nobody knows what the future is really going to be, other than everybody was fearful of the sunset of the Tax Cuts and Jobs Act that was scheduled to happen in 2026. I think myself and many others now are not considering that a sunset. I think we're entering a period of sunrise in taxes. I think with the Trump regime, there is going to be a big emphasis on trying to deliver on a lot of campaign promises and also improve the economy. And it's going to be a fine balancing act on improving the economy. Taxes, low taxes generally help the economy. On the other hand, deficits and what that brings definitely hurt the economy. So we're in a little bit of period of transition here. But I want to caveat our discussion by saying we don't know what the future is going to be. I'll make some comments about what I think may be happening, but remember that that's pure speculation.
But Andy, there are specific things that we know that they can do. There are things that you can control and decisions you can make now for the end of the year and on into 2025. And I think that's what we want to share with today, right?
Absolutely. And I think the real key in planning is getting involved with your tax preparer, not after the year end, but really before year end. And we only have 5 weeks left. So you say, what can I do in 5 weeks? There's actually things you can do in 5 weeks and get in place to shift the needle of where you are and your income. And the reason it's important, and we'll get to, is the fact that we're trying to really manage where you are as far as paying taxes this year, next year, or in the future. 6 weeks ago, everybody thought taxes were going up. Now, I think people are of the belief that taxes are going to stay the same, possibly even get lowered depending upon their situation and what rolls out of this new tax legislation. But we'll give you some ideas of things that you can do today. Be patient. We have a whole litany of things that you can at least think about, but you need to talk to your tax preparer about them and work with your specific set of facts rather than just thinking everybody can do this. And a perfect example here is managing inventory is going to be critical, and Mark's going to talk about that near the end. But and keeping in mind that managing inventory not only will impact your income taxes, a number of states impose excise taxes on year-end inventory levels as well. So when you have your sale, when you donate, whatever, could impact not only income taxes but excise taxes as well. One of the big areas that you're going to find that we're going to talk about are capital improvements. We'll get into that later. Retirement planning. You might say to yourself, "What? We're too late in the year." But there's if you don't have a retirement plan, if you really have only you and your family running your business, there are things that you can put in place right now that are simple, and in some cases they have to be drafted and in place before year end. In some cases, you could wait till you file your tax return. In all cases, you can typically wait until you file your tax return to make your payment for your deduction. That first bullet point, again, I would not be worried about. We are going to have expiring benefits in 2026. I do not think that's going to really happen. My view on what's going to happen, and you heard it yesterday, President Trump is going to act on day one of his presidency. So January 21st, we will probably see some executive orders. I don't think they're not going to impact taxes, but there will be executive orders. As Mark indicated, he can impose tariffs, and that can happen very, very quickly. And that has an impact on purchasing and other strategies going forward. Mark, I know has been involved with a number of you and his clients dealing with all of the COVID legislation that happened and payments. And are they probably being handled? Are they being reflected properly on incomes on balance sheets? He may refer or talk about that a little bit later on.
I'm going to say about, and I'll bring it up now, is that, as you create new balance sheets for the end of the year, make sure you're caught up on EIDL payments need to be posted, and and updated for current balances. I've looked at a half a dozen balance sheets and it's been completely ignored, or PPP loans that have been retired and you've been given grace on them. Make sure that your balance sheets are updated.
And on the point here on capital gains, I think we don't know what's going to happen. There's been discussion of lowering them by Trump, so we may be entering into a period where you really need to consider what your succession plans are. Do you want to sell your business? We may be entering into at least a 2-year window before the next election where it may be nirvana. It may be a perfect time to sell your business before the next congressional election. So think about it. Selling a business is not something you just do right, without thought. You need to plan for it. And there may be opportunities over the next couple of years that we will not see again.
So I think on import tariffs, they may impact your business. That would be another whole webinar and discussion. And we're going to really focus on it. Tariffs are a tax, but we're going to focus on the IRS side of the taxes. So let's get into it.
Well,
before we go into, we just kind of wanted to lay the landscape down of where we are right now, and then we'll go into specific strategies.
So the key in our planning right now is 2024, it's in the books. Nothing's going to change on 2024. Most likely, 2025 is either going to be what it is, or it may be even getting better depending upon effective dates of any new legislation. This is what was originally going to be sunsetting in 2026. And a lot of people in the past, were doing planning about this, especially if you have larger estates. Estate planning was critical, but I think it may only get better. One of the points here, the state and local tax exemption or limitation. President Trump has indicated he wants to get rid of that or make the limit much higher. So again, things may be getting better. He really ran on lowering taxes, not increasing taxes. The key is going to be balancing taxes and our deficit. Part of the problem we are all facing is what the continuing deficit is. It's been estimated that making the 2017 act that manages our taxable incomes today, if it gets extended or made permanent, it could have a $4 to $8 trillion impact on the economy. And really on the deficit. So we need to understand what that increased deficit how it would impact the economy and your businesses. This is what was going to happen that most likely now is not. We're in a system where there are 7 different tax brackets, and we're going to be talking a little bit how the different brackets impact you. But this slide basically shows what we are currently under, the tax rate under each bracket, and what it was going to be if the 2017 Act expired. But again, I don't think that's happening. I think it's going to be. Trump has indicated that he wants to keep the maximum rate at the 37%. So I don't think that's changing. There may be some changes in the brackets themselves. We don't know what they're going to do there. But again, it's all revenue based and trying to manage the deficit. Again, see, these are some of the changes that were proposed that are not most likely now not going to happen. It's good to know and just be aware of some of these, because you never know when they're going to raise their head again and become an issue. But for now, I would ignore these, other than I think the state and local tax deduction, which has a limitation on it, is going to only get better rather than worse.
So you see the $10,000.
Yeah, right
change.
now there's a cap of $10,000 on state and local taxes, and Trump has indicated he wants to eliminate that and go back to what the original pre-2017 law was, which basically did not have a limitation. The estate and gift tax, again, you heard about everybody and the wealthy. I'd be surprised if the estate and gift tax exemption got cut in half, which is what it was proposed to happen under the sunsetting. I think it's going to stay where it is. There may be some limitations on the growth of it, which would help again on the deficit, but I don't think it's going to go down. The qualified business income tax deduction really was in my mind, a great provision and really helpful to all of you. It was more to equate pass-through businesses taxation with corporate taxation. Corporate taxes are now at 21%, and this was to try to reduce the impact of personal tax rates, which are higher for business income. Keep in mind, Trump is talking about reducing the corporate income tax to 15%. We don't know what would happen with the qualified business deduction, but if they're trying to maintain the parity, that might get actually improved as well. One of the big areas, and we'll talk about it later on, is in bonus depreciation on qualified property. That currently is going through a phase down under the sunset rules. It used to be 100%. 2024 at 60%. Next year it's going to be less, and eventually it was scheduled to go to zero. Trump has proposed to bring it back up to 100%. Again, we don't know what's going to happen, but this is a key provision that you could use to help manage your taxable income. And we'll get into it a little bit more, but there are two deductions. One is called 179, which is an immediate write-off, and the other one is bonus depreciation. So these are provisions that can help you manage your income based upon when you put capital assets into service, whether this year or in 2025. All right, the key factor, and I hope this is not too simplistic for all of you, but it confuses a lot of people, so I just wanted to talk about it. First of all, for 2025 versus 2024, the 7 brackets are staying the same. They were just inflation adjusting the break-even points of when they hit. But the key to understand is the difference between effective tax rates and marginal tax rates. What I'm trying to have you understand here, just so you know the difference, is we're in a system of different levels of income are subject to different levels of tax. So the first break point really is $23,200 in our tax system. It's taxed at 10%. The next $71,000 of income is taxed at 12%. And if your income is greater, and this is taxable, and I'm talking about, the next $106,000, roughly of $106,750 of taxable income is subject to tax at 22%, and the next $182,000 of your income is taxed at 24%. So what does that mean? That in total, that's $383,900 of taxable income. And what is your, are you taxed at 10%, 12%, 22%, 24%? You're really taxed at all of those. So on your $383,000 of income, your tax would be in total roughly $78,000. On a blending that together, $78,000 of tax on $383,000 of taxable income means a 20% effective tax rate. But guess what? Your next dollar of income, if you're trying to put more income into 2024, would be taxed at 32%. So that's your marginal rate. The marginal rate means what is your next dollar of taxable income going to be taxed at? And it's critical for you to do planning, looking at what you think you have in income for 2024 and 2025, because you're going to be wanting to manage what your marginal tax bracket is. You can see there's a big jump in between 24 and 32%. So if you're in the 24% bracket, you're going to be increasing your tax liability by an additional 8% over what the prior dollar was. So here, this shows you the 2024 brackets, whether you're single, married, file separately, whatever. And you can see how the different tax brackets are impacting different levels of income. So perfect example, look at your income. If your taxable income is $383,900, you're an effective, as I talked about, effective 20% tax bracket. You're currently in the 24% tax bracket, but your next dollar of income would be in the 32% tax bracket and taxed at an 8% higher premium. So that's why you really need to understand and do planning, not only for this year, but for next year, because you're trying to determine which would be the best year for me to either accelerate income into this year or defer income into next year. And that's 90% of your planning that you could do is managing your tax brackets. It's really tax arbitrage. Which tax year is the best year to recognize income? And again, how you might say, well, how do I push income from this year into next year? Mark will get into that in some inventory discussions. If you're cash basis, you can obviously do it by managing payables and receivables. You all know the tricks that you've done with your cash registers, managing how you report income at the end of a quarter. And this happens to be the most important quarter to do that managing. The ramifications of managing income. It may affect your balance sheet. It may reflect on how you look to your bank and others out there. So you need to manage the tax benefits versus the business issues. But again, it's critical for you to be able to understand where you're going to be in 2024, where you're going to be in 2025, and more importantly, what do you think 2025 is going to be from a tax environment perspective versus 2024. Some people are saying, it may be a better year in 2025 than 2024, depending upon what happens with this, the new legislation. And when will this legislation come about? My guess is the priorities of the president, other than the day one orders he's going to give, is immigration, number one, and number two, taxes. There's going to be a big push to get new tax legislation in place as early as possible. That doesn't mean tomorrow. It still has to go through Congress. There are still budget issues that are going to have to be recognized and dealt with. They'll most likely use a process that was used when the 2017 Act was passed, that will result in it being able to be done with a simple majority in the Senate, rather than the 60 vote requirement that there's typically there. So it may happen. It probably will happen by the third quarter. And it's going to impact not only ordinary income, it's going to impact capital gains. One of the provisions that Trump has indicated is he'd like to cap capital gains at 15%. But again, we'll have to wait and see what will happen. But if he does do it at 15% and gets rid of the 20% tax bracket, that will mean that you really are going to be looking at any succession planning, selling of your business is going to be critical over the next couple of years, as long as that if there is a 15% maximum capital gain rate, that will be the time to look at selling your business and planning to sell your business. All right, so some planning decisions, as I mentioned. Managing income. Are you going to accelerate income or defer income? And how do you do that? First of all, you need to understand where you think your business is going. And you may say, I have no clue what 2025 is going to be. And that's probably, for most of you, it may be a crapshoot. We don't know what it's going to be. It could be impacted by the tariffs that Mark's going to talk about. That could have a detrimental effect on pricing. And if it is, and you do think that that's what's going to happen, and that's going to hurt your income and bring your income lower in 2025, then deferring income into 2025 versus 2024 makes sense. And how do you do that? Again, tricks of the trade, managing, if you're cash basis again, managing your receivables, managing your cash flow, managing, how you sales, etc. And Mark, you're really more of the expert. You've been there in the field. You know how to do it. Any ideas from you on how to manage your income?
Well, in terms of managing your income, if you're on cash basis, I don't really want to talk about it on here, but you can postpone some receivables into the next year. Most of our clients don't use receivables, so it's not going to, most managing one clients don't have receivables, so that really wouldn't be an issue for them. I mean, I think the biggest lever they have to pull is on their inventory, which we'll talk about in a little bit. But I do think in terms of, what they do in terms of their capital improvements, how they depreciate those this year versus next year, certainly can be, part of their strategy.
And keeping in mind, Mark has indicated that the majority of you out there have your businesses in pass-through entities. So the ultimate taxation of your business income is on your individual taxes. So it's really a combination of managing your individual taxes at the same time as managing your business flow through taxes. So there are, simple things, charitable contributions, etc. If you're itemizing deductions or not itemizing your deductions, which year you take the deductions, that's a way to manage your taxable income. You're doing a Roth conversion. If you think you're in a lower tax bracket right this year, you may want to convert some of your IRA income, excuse me, by doing a Roth conversion. And you can work with your accountant to try to, again, what's that break-even point? How much additional income can you generate in 2024 and stay in the 24% bracket or stay in the 32% bracket? And if you have excess capacity and once your retirement plan starts paying out, you're going to be in a higher tax bracket, you may want to do a Roth conversion this year to push income into this year. And then you might say, I have no clue going forward what's going to happen with income. Should I still do a Roth conversion? I just want to highlight one other point. Roth conversions also help your heirs. When you pass away, and you can either leave them a liability account, in other words, they're going to have to pay the taxes on your retirement assets, or you could pay the taxes on these retirement assets now and leave them a tax-free asset going forward, being a Roth account. So it's more than just trying to do tax rate arbitrage this year versus next year. It's also about, are you what are you leaving your heirs, and what's your preference there, and will you have a taxable estate? Hopefully you all have a taxable estate, but given that today you need more, and $26 million of an estate between a husband and a wife, I hope you're all there, but maybe you're not. But in any case, don't forget about some other things you can do. One being annual gift tax exclusion. You can give away $18,000 a year. That's a way to shift out of your estate and also help your family. Let's talk about business structures. We talked a little bit before about how this qualified business income deduction came about with the 2017 law. Again, I doubt it's going to disappear under the new legislation. It may be enhanced, and if it is, that's great. But we may be entering an environment in the future where we will see people going to C corporations as opposed to pass-through entities if the advantages are great enough. And one of the things that Trump has suggested is that he's going to be reducing the corporate income tax rate and trying to entice people to go to C corporations rather than pass-through entities, but we'll have to see what happens with legislation. Estate planning, as I said.
So Andy, on the business structure, and you talked about paying, maybe postponing a dividend if you're a C corp to next year, if you think your profit levels are going to be less than they were this year. Would that be a strategy?
Well, keep in mind, if you're a pass-through entity.
Well, no, I'm talking about if you're a C corp, because if you're a pass-through entity,
if you're a C corp, we're now dealing with two levels of tax. Paying a dividend doesn't help the corporation as a non-deductible expense. Paying the dividend will be taxable to the recipient. So it's really a question of, as a recipient, what's your taxable income? Can you pay the tax on that dividend at a lower tax rate or a higher tax rate? And keep in mind that if it's a qualified dividend, it's subject to a lower tax rate. It's subject to the capital gains tax rates rather than the ordinary income tax rates at the individual level.
So does it make sense to postpone a dividend to next year if you think your profit's going to be less next year than this year? Again,
if you're a C corp, paying a dividend really doesn't change anything at the corporate level. It's not a deduction, so it's not going to impact your income at the corporate level this year or next year. It will impact the recipient of the dividends income this year or next year, but it will not impact the corporate level.
So also, if you're already a C corp, what about applying to be, I think it's either a 1401 or a 1402, I can't remember, corporation where when you sell it, there's no capital gains tax?
Yeah, that's one of the great advantages of being a C corp. There are a lot of limitations. You can't convert from being an S corp to a C corp. You have to have always been a C corp from day one. And if you meet that test and a few other tests, you're talking about the small business income tax, which basically would say that if you sold your business and you qualified for this exemption, you would not have to pay any tax on the sale of your business. Right. So that's a huge advantage. People do take advantage of it. The problem is that you do have to be a C corp from day one in order to qualify for that provision.
So if you're thinking of starting a business, talk to your accountant about what the best entity for you to be. And
we'll know a lot more next year after this legislation passes. And if they do reduce corporate income tax rates versus not increasing the QBI deduction to try to offset that. Another thing to think about in that area is how quickly you're going to sell your company. I will tell you, there are a lot of, in California, high-tech companies that know they're going to be sold very quickly in the technology area, have recently been going to the C corp structure so that they can take advantage of that exemption from tax. Yeah, one thing that and I'm not questioning your. I'm not sure about this. You said you had to be a C corp from the beginning. I've also read that if you change to a C corp and you qualify as I think it's a 1401, you'd have to check, but it has to be in place for 5 years. So I think there might be some exception, but I'm not sure that you'd have to check with your accountant. It's just what I've read. There are a lot of technical rules. Again, this is just to highlight opportunities to think about. And again, all I want to stress, I come from the accounting world, and business people are reluctant to talk to their accountant until they give them a shoebox full of everything to do their taxes. The key to be talking to your accountant is before year end. Planning before it should be done all before year end, not after year end. Okay, we've got about 15 more minutes before we're going to take questions, so we want to move on. But here's some additional pointers that you can think about.
check your withholding and estimated taxes. You want to talk a little bit about that so you don't underpay and
Yeah,
cause a problem for yourself?
Obviously, I think probably many of you are S corporations, and one of the tricks in S corporations is that you pay a reasonable salary, and then the rest of your income comes through as just pass-through income, and you're not paying self-employment taxes on it. Keep in mind that you can manage, you have, in order to avoid an underpayment penalty, you have to pay in 100% of your prior year liability or 90% of the current year liability, and on a quarterly basis. And so you may, I find a lot of people aren't paying in their 100% of their prior year liability, and they're left hanging near year end, and they say, what can I do to avoid penalties for prior quarters? One thing you can remember is if you pay in through withholding, it's deemed ratable throughout the year. So if you increase your withholding, and that could not only be for salary, if you're taking any RMDs from retirement plans, and you're doing withholding, you can over withhold, and that over withholding will be deemed ratable throughout the year. So that's a way to avoid underpayment taxes.
So it's a good idea to double check with your accountant that you're paying your estimated taxes correctly.
Yeah, make sure that you're have been filing what's called a safe estimate. The safe estimate is 100% of your prior year liability. If you haven't paid in on a safe estimate, then you can still do these mechanisms to try to avoid an underpayment penalty. I also want to remind everybody that with all the bad weather and all the environmental issues we've been facing, there are 34 states that have federally declared disaster areas that can avoid underpayment penalties, that can result in a delay of when you have to file taxes. So keep in mind, work with your accountant on that one. Also remember, 2025 is scheduled to be a different year if you have an inherited IRA. If you had an inherited IRA from someone who passed away after 2019, there was this new rule where it had to be disposed of within 10 years. And there was a question that it have to be done ratably or not. And the IRS finally issued regulations. So starting next year, you're going to have to start taking RMDs, and that will increase your taxable income in 2025 as opposed to 2024. So again, that's a factor that may increase taxable income next year and change your marginal tax bracket.
Marginal tax factor, thinking of back to the chart of 32% and so forth.
Right. I mean, you're trying to, assuming you're a pass through and you're looking at everything at the individual level, you're trying to look at what will influence what bracket I'm in, because I could save 8% by pushing income this year to next year, or the same thing from 25 to 26, if I can keep myself underneath the 32% bracket in the 24 and stay in the 24% bracket.
Right. We talked about the $18,000 per person exclusion. Then take all RMDs. So I do have a question on the one, this is after 2020, but if it's before 2020, is that under the 10-year rule? Do you know?
No, if you inherited an IRA from somebody who died prior to 2020, then you're 2020, then the old rules were you had to take out distributions over your life expectancy. So you were taking distributions every year anyway. And if you were younger, you didn't have to worry about this 10-year rule. What the IRS did, or really what President Trump did, it was in 2017 was pushed in this 10-year rule. So some other things I just want to point, if you're doing charitable contributions, if you're philanthropically oriented, instead of donating cash, donate appreciated property. There are some limitations, but you'll get the benefit of the full fair market value of the property as long as it's a long-term capital gain property and not short-term capital gain property. And you won't have to recognize the gain and pay the income tax on that built-in gain. in your situation, you'll just get the outright deduction for it. Another way to manage income is, depending upon your businesses, most retailers can't take advantage of it, but using installment sales, you can, if you do what qualifies as an installment sale note, you have the ability to manage which year you recognize the income. So that's just something that I'd like to throw out. There are, I think what's a great risk going forward, I think the tax laws as written are probably going to stay the same or get better. But some of the, what I call caveats that are built in, some of the planning opportunities might disappear. The IRS has been pushing to change some rules that they consider abusive. One of them is using what's called an intentionally defective trust, which allows different treatment for estate tax purposes than income tax purposes. Really mainly critical if will be subject to estate taxes. Also, the ability to use discounts when valuing your estate. That's another area that may disappear. The IRS would love for it to disappear. We don't know what's going to happen, but just wanted to highlight that as well. Some additional pointers, Mark. I'm not sure if we even have them on the slides, but one thing I wanted to mention, I don't know how many of you that have pass-through entities remember that last year they passed a law called the Corporate Transparency Act that requires reporting annually of who the owners of your business are. If your business existed prior to last year, you didn't have to report until the end of this year. Just want to remind everybody that there is an outline requirement to file this beneficial ownership information under this law, and it needs to get done before January 1st. If you already haven't done it, they're pretty nasty penalties. Again, talking about, Mark, did you want to talk about any? I think you already did on some of these employee tax retention credits and things like that.
Well, the ERTC is taxable income. So if you didn't get it this year and you get it next year, it'll be postponed. But you do probably a good idea to whoever's processing it for you to follow up on it, because there's been a long delay in processing those claims. And then I think the last one, considering accelerating equipment purchases, for our clients, it could be technology, it could be POS systems, it could be leasehold improvements. So the depreciation schedules will be reduced. So that would be a consideration in when you want to shift taking
I
those
can't tell you,
deductions.
I get a call from this one client every year. He asks the same question. You would think he would know the answer, but I think he just likes talking right around Christmas. And
I think that's
the
me.
question always is, should I buy a new delivery van this year or next year? And what he's getting to is that there's two things when it comes to capital improvements. One is called the business expensing election. That's the ability, Section 179, where you can get a full expensing of a capital improvement. The other one is what's called bonus depreciation, which was also at 100% and is slowly being phased down. Again, we don't know what's going to happen to it with the new legislation. But in any case, capital, if you're looking at buying something, whether it be software or equipment for your business, a new delivery van, you will be able to get that written off in full. So that's a perfect way to manage your income. The client I was talking about hates paying taxes. He basically manages his income down to almost zero. And he does it every year with equipment purchases. So keep that in mind when you're buying equipment, or if you're looking at, like I said, buying anything that's associated with your business that would be deemed a capital asset. There's a way to expense it before the end of the year. Another area, we mentioned it briefly before, retirement plans. You may say, hey, I only got 5 weeks left. What am I going to do? We don't have any retirement plan. And the business, you look at the business and it's basically the employees are or you, your wife, and your children, and one of your children. You know, there are great plans you can put in place where if it's in place before the end of the year, or even in some cases, depending on upon the plan type, you can do it after the year end, but you can get a large deduction and manage your income without giving any money away, just by putting it into savings. So definitely consider that. One of the reasons people don't do it is because they're, you know, from a corporate side, do you want to cover all of your employees? If you have a long-term employee and you treat them as family, it makes sense to look at doing something. So look at putting something in place there, because there are great things you can do there.
I just want to add, I get a call the end of every year from a client thanking me for telling him about creating a cash balance account in their plan, because most of that money goes to you, and it's a great way to hide income and defer it to your retirement. So.
Yeah, and you say, well, why do I want to defer this income to my retirement? We don't know what tax rates are in the future, but if you're young, you have a long time frame. You have a long time to get build up of tax deferred income in that retirement account.
Right.
So something definitely to consider.
So the other things on the slide we kind of touched on before, but I want to get to inventory write-offs and inventory write-downs, and they're different. But the purpose of managing your inventory and taking a hard look at it is a tremendous benefit to paying taxes. So if you are writing off or writing down inventory, you're reducing your inventory, which increases your cost of goods sold, which reduces your profit, which means you'll pay less taxes. And you've got about 5 weeks to help plan that out with your accountant, so you should be doing that now. If you talk about write-offs, there's a difference between a write-off and a write-down. A write-off is where you're disposing the inventory. You're going to give it to charity. You're going to sell it to a liquidator. It's not going to be for sale next year, and that's a pure write-off. And that again is it's typically done on your balance sheet. And again, if you have a POS system, you have to go in and take all of that out. And examples are damages. Shrink is certainly, when you take inventory, is certainly part of it. The quality of the goods. And then, write-downs are a little bit different because, and make sure I get this correct, Andy. On a write-down, it's available for sale, but it's not a complete write-off, but it's available for sale in the future, but it has to be written down below the cost value. So one way to look at it is to say, my markup is 55% overall, my initial markup. So if I mark it down more than 55% or more, I'm now selling it below cost, and add freight in because that's part of your cost of goods. And that would be a good rule of thumb. One of the things you can do in determining that is to obviously work with your Management One retail expert to come up with what those numbers look like with you and your accountant, and also to run aging reports on your point of sale system, because depending on the type of classification it is and the length of time that it's been in your store, if you haven't sold it after a certain period of time, there's a good chance the only way you're going to sell it is to mark it down below cost. So one thing to think about, and some people like to treat their inventory as their Mr. or mistresses, they're just afraid to get rid of them. But the fact of the matter is, if you've sold 80% of your goods at pretty close to full price, then whatever you have left, you could give away and it doesn't matter. You've got your profit out of it. And I think people worry about that too long. You need to turn that into cash. One way to do it is to sell it to a liquidator. So again, this is one of the great ways to do it. On this, identify what it is, calculate what the write-down or write-off amount is. You're going to make a journal entry. The best place to do it is on your cost of goods sold, and credit your inventory account. It'll impact your financial statement, and you'll have less taxable income to pay taxes on. You do not want to be paying taxes on inventory that's sitting on your walls, which also brings in, for those of you that are thinking of front loading your inventory, because you're worried about tariffs, think about bringing those goods in January. If you bring them in December, they're part of your inventory. And the government could technically look at when they were landed in terms of your UPS or Federal Express or whatever tracking system you use. So be very careful about that, or thoughtful about it. All right, so I see Heidi's on. I guess there's probably a lot of questions. We're a minute over, so Heidi, let's hit it.
All righty. Love that discussion. Follow up on business reducing their taxable income. If an owner of a business decides to reduce their taxable income, which results in the business showing it makes little or no money, doesn't this negatively affect the asking price when the owner goes to sell the business?
Well, that's a great question.
I don't know, Mark, you could probably speak to it as well, but my experience is buyers of small businesses understand that income is manipulated in some cases. You may have your kids working in the business, you may run some credit cards to the businesses. Not that I'm saying that these are illegal or anything like that, but everybody knows that in small businesses, there needs to be adjustments. And typically when a small business is being sold, there is whoever's helping you sell it, whether you have a broker or whatever, will would come up with what probably would be adjusted gross income to take into account all of these type of quote non-recurring expenses if somebody else bought the business. So I think there's
I just want to add there too, Andy, not to cut you off, but when you look at selling a small business, they're not looking at EBITDA. They're looking at what the owner takes out in salary and perks, in dividends and those kinds of things. So and then there's a multiplier that's based on a lot of different other factors. So selling a small business is different than selling it. I think the other consideration is you want to have a balance sheet that's strong enough to get credit. So you don't want to be losing money. You don't want to write off so much inventory that you're going to lose money. You still have to have the benefit of the creditors. So there's that. So it is a balancing act, right? So you want to make sure you're profitable. But again, think about the current use of money, right? Do you want to pay a lot of taxes, drain your cash for the benefit of having a financial statement on a business you may or may not sell in the future?
I think that's a great point, Mark. I think you have to always manage, as I indicated before, what your banker and other interested parties are feeling and looking at your value of your business. But I think most people will take into account, they know small business has one goal, and that is not to pay taxes. And so everybody adjusts it.
Right. When you sell the business, they're going to look at what's put in your profit sharing, what you put in your cash balance account. All of those things get looked at in the due diligence process, and they're all factored into the rate of sale. Because when somebody's buying a business, they're buying it based on how quickly they can pay it back.
Next question, Mark, probably for you more than anybody. If you take a write down, do you also have to reduce the retail price to match your POS?
Okay, that's a good question. If you take a write down, you should match the number on your POS if you can. But again, when you're on your tax return, you're going to have your beginning inventory from the previous year. So next year you're going to be using that inventory number. You're not going to be using it off your POS system. You're going to be using it off your financial statement, because POS systems are based on cost accounting. They're not going to match up very well because you're always making adjustments to your inventory. You should account for shrinkage when you reconcile your POS system. But the issue, the challenge that you're talking about with that question is most clients take POS markdowns, not hard markdowns. So if you really want to take hard markdowns at the end of the year to devalue your inventory, there's a process to do that. And if anybody's interested in the math on that, I don't want to go into it here, but they can certainly contact me.
And remember, at one point on that, remember that for tax purposes, there are different rules than for GAAP purposes, for accounting purposes. And to get the write down, you do have to offer it for sale at a lower price. So make sure you
lower than cost.
System.
Lower than cost.
A follow-up, a through line on this question is, what about approved methodology for write-downs? What's the approved methodology for write-downs? Previous years, I've written down based on aging, but now I will look at writing down already written down groups of inventory.
So, if you look at the IRS rules, I mean, I think there's some, there's probably a little gray area here that you should probably discuss with your accountant, because they've got to be comfortable with how you're taking your write downs, but they also have to be, there's two things that are important. One is consistency, that you're consistent year over year on how you do it. And the other is that it can be documented. So there are things that allow you to, there's POS reports, there's Management One reports, there's other reports that'll give you the documentation to make the decisions on how you're going to write down your inventory. So for example, on the Management One report, there's an inventory deviation number. Well, that deviation number is the difference between what you should have and what you don't have, or what you do have and what you should have. So if the number of what you have is greater than what you should have, there's probably a lot of aged inventory that could be depreciated or devalued, which you're allowed to do, and you're actually expected to do. So there's lots of supporting documentation that you can use to make that happen.
Last
But to
question.
Andy's point, you have to be able to, you have to expect to sell it below your cost or give it away entirely.
Technical question is the last question. When they receive the recording, I don't know this answer. Will they receive the slide deck as well? The notes you have, PowerPoint.
Yes.
Boom. All right. That concludes this end of year tax webinar. Thanks so much to everybody who joined us. And like I said, you will get this recording in your inboxes. Mark and Andy, thank you both so much. Wealth of knowledge. I appreciated it, and I'm sure everybody else here did as well. So we will see you back on the next webinar.
I have a question. So if people have questions, do they contact, what's the email address they go to or call?
If you have further questions, I would say you can actually contact me and I will get them to the right person. It's Heidi@management-one.com.
Thank you, Heidi. Thank you,
You're so
Andy.
welcome.
Really
Thank you
appreciate
all.
it.
Thank you, Mark and Heidi.
Appreciate you. Bye-bye.
Bye-bye.